Welcome to the Hustle Class Podcast. We have a quick disclaimer. All material presented within Hustle Class LLC is not investment advice, but for educational purposes only. Trading involves risk, and you are solely responsible for your investment decisions and assume the entire risk of any trading you choose to undertake. Owners of Hustle Class LLC and its representatives are not registered as security broker-dealers or investment advisors, either with the United States Securities and Exchange Commission or with any state securities regulatory authority. Please utilize a registered investment or financial advisor to make any financial decisions. If you choose to invest without seeking advice from such an advisor or entity, then any consequences resulting from your investments are your sole responsibility. By utilizing Hustle Class LLC and our content, you are indicating your consent and agreement to our disclaimer.
Welcome to the Hustle Class Podcast. Thank you all for tuning in. It is your boy Jermaine, and I am back at it again with another one. You already know how we do up in here. This is the Hustle Class Podcast, where you can come and learn for free all the free game in the world. I mean, we talking stocks, we're talking NFTs, we're talking crypto, we're talking real estate, we're talking budgeting, we're talking saving, we're talking stacking, we're talking health, we're talking wealth. This is the Hustle Class Podcast. You already know how we give it up. And how we usually start our podcast is, I go to the Hustle playlist, I grab a song off of it, and then I give you some of the words from the song. So today, the song that we focused on is Rose Clique by Nipsey Hussle. Right? He says, I'm way out of your league, so please excuse my ego. Diamonds on my Cuban link, my Rolex presidential. Penthouses and beach homes, Perrier and Patron. Told you before about this baller-ish I be on. Whew, bars. Come on, Nip. So you see, the reason why I chose this song today, I already know a lot of y'all got y'all tax returns. A lot of y'all waiting on them. I know some of y'all got that bonus from work. Some of y'all got that raise at the top of the year. And y'all trying to splurge. So I just had to give y'all some of Nip's splurging. You feel me? The diamonds on the Cuban link. The Rolex, the presidential. Penthouses, beach homes, Patron. You already know, man, we ball, right? But, don't forget, sometimes if you balling out and you just throwing away your money like that, you lacking. And if you lacking, you slacking. And if you slacking, you ain't stacking. And it's about stacking now and balling later. So don't forget that. You got to stack now. All right? All right. So, like I said, I'm Jermaine. I've been getting to a bag. It's been a crazy new year. I ended last year, kind of in a tight spot because, I had to make some big moves and, cop a little crib or whatever, for the real estate play. And, I copped the real estate play. Like anything, sometimes when you first make an investment, you'll be down, but you want to buy an investment when it's red because, then all you really have is upside, right? So you want to buy the dips. That's what they mean by buy the dip. I got the home at a discount, I finessed, and here we are today, right? On our way to equity. Let's go. I hope everybody's motivated to do the same. Interest rates are rising. They're still not too bad. If you have the opportunity to stack and create a home, or to not create a home. Well, some of y'all gonna create a home, but to buy a home, you know what I'm saying? I have an episode that, 2 episodes that are titled So You Want to Buy a Home, Part 1 and Part 2. I suggest y'all tune in, y'all tap in, and y'all take that information and y'all execute on it. And I'm sure that the results of that are going to be magnificent, to say the least. All right? Bet. So today, right? And this is how I know I'm a genius, right? Not to toot my own horn or anything. So I was sitting down and I was thinking to myself, Tesla already split their stock. They're going to split it again. Everybody's been waiting on Amazon and Google to split their stock for ages, and they're now splitting their stock. But the state of the market isn't so good, and the interest rates are rising, and, things aren't looking too good from an economic standpoint. So why is all of this happening? Not to say that anything is a product of causation, but sometimes correlation can tell us a story, you feel me? So I began doing my research online. I was like, what do stock splits have to do with rising interest rates? And every single article is weaving and bobbing, weaving and bobbing. I can tell that they don't want your boy to know this information. I can tell. You can tell when somebody doesn't want you to know information by how hard it is for you to find that information. If it's so difficult for you to find that information, you know what I'm saying, they're probably trying to, set you up in a way where, you know what I'm saying, you're not going to be able to, capitalize on that information, right? Because, silence is, one of the biggest indicators that happen in the stock market. People tell you about technical indicators. People tell you about, non-technical indicators, like fundamental indicators. Cool. That's all fine and dandy. But, when a stock is moving or, company has a lot of potential, they're in profit, they're doing a lot of great things, and the news is quiet about them. Yeah, that's where somebody like me steps in, because that's opportunity. Right? Because the same way you're waiting for, a dying stock to wake up and crank up, I mean, silence is a place where you can buy. And then once the talking and, the buzz starts happening, everything on that upside you're a part of because you got it while everybody was quiet about it, right? So I couldn't find a single article on that. But then guess who had an article? BlackRock. Now, some of y'all might be like, who's BlackRock? I don't know what BlackRock is. You know what I'm saying? And I don't blame you, right? But BlackRock, right, is an American multinational investment management corporation based in New York City, right? And they're the world's largest asset manager with $10 trillion in assets under management as of the top of the year, January 2022, right? So I'm looking all over the internet for articles about stock splits and how they correlate or relate to interest rates rising. And the only place I find it is on some page 5 or 4 in Google on BlackRock's website, because somebody, mustered up the courage to put an article out on it, which was great. So I read it, like the scholarly man I am, and I got that free game. So this is what I have to say about stock splits, right? Because, everybody wants to buy a stock when it's splitting, right? Because the rush after the split is going to drive the price up, as a lot of us assume. There's no said assumption. But that's how we usually act, because stocks is all about human psychology and how we move, right? So when companies try to split their stocks, right, what happens is, in the case of, say, Tesla, Amazon, Google, these companies have stock prices that to our eyes look so astronomical that we don't want to buy a share. Who wants to pay $3,000 for a share of Amazon when you can buy NIO for $30 or $20, right? Who wants to spend almost $1,000 on a share of Tesla when you can just spend that one whatever on Apple, right? So these companies like to perform stock splits to make the price of the stock more attractive for retail investors. Now, where sometimes people get this messed up is they think when a stock splits, the stock is cheaper. No, the stock isn't cheaper. It's just divvied up more. For example, just because I break $1 down into 4 quarters, you can say, oh, now I have 4. But you don't have 4 more dollars. You just have 4 quarters. So you have more. But as you add them together, it still equals the same whole. And that is why a stock split does not change the underlying value of any of the stocks, right? So take that in, right? Take that in. I know it's a lot to, take in, but just play it back, listen to it. You'll understand it. Trust me. A stock splitting is the same as splitting your dollar bill at your bank for 4 quarters. Sure, now you have 4, but you have 4 what? Quarters. Not 4 more dollars, 4 quarters, which still make the one whole. You just have more of a quantity, right? So, but that makes it more attractive for retail investors nonetheless, because some people are not attracted to value, they're attracted to quantity, right? This is psychology here, people. So that's why they do that, right? And, why people might want to make a stock split happen, right, in a time of tumultuous market activity like what we're experiencing now, is potentially because, right, when things get bad and stocks drop,
right? If you don't dilute your shares and break them up into more, your drops are going to be more devastating, right? Like, for example, it's a lot easier for me to lose $1 than it is for me to lose all 4 quarters. That's the analogy, because I have 4 of them. So I might lose 1 or 2, but I might still have 2 or 3 left, right? In terms of quantity, right? But like I said, some people are attracted to quantity, so they don't really understand because, if a stock drops 10%, it's relative. Like, maybe it didn't drop that much because the stock had split, but the value, right? If you're looking at it even from a market capitalization standpoint, it's still reduced the same. It just didn't look as bad because the stock had split and now it's more diluted. So the moves it don't move up too much. It don't move down too much, right? And this is something that we call liquidity, because when they split the stock, they basically increase the liquidity of the stock, meaning it's now divvied up more. So it's more easy to transact. You know what I'm saying? It's easier for me to split the 4 quarters 4 ways than it is for me to, tear up my dollar, right? So when you do the stock split, it increases liquidity, makes it easier to transact because there's more to go around. And when there's more to go around, there's also lower volatility. And if there's lower volatility, that basically means that the stock price isn't easily manipulated at that point. So if we do fall on tough times or extremely good times, the stock price won't really be too affected by that. It kind of dilutes it, right? So now, as I kind of talked about, right, rising interest rates mean that a lot of people are going to need to hold their cash more because everything around them is getting more expensive. Inflation, cool. Now, because that's the case, people are looking to take their money out of certain stocks, right? If people are going to take their money out of the Teslas, the Googles, and the Amazons, because those they haven't diluted yet, that's going to draw the stock price down tremendously. So when they do the stock split and they perform that dilution, their stock price won't drop that much after that if people do decide to sell because times are indeed rough. That is what I figured out and read is the correlation at times, right? Because, this is just me doing my research. Nobody has an article on it because nobody want to put that out there. But, I'm a boss, so I did it. But that is the correlation I see between the stock splits. Why is everybody splitting their stocks at the same time? The stock splits and rising interest rates, because for me, it didn't make sense. We're not in a good time economically. So why do you want to split your stock? To encourage more investors, because they want to increase that liquidity. And another thing about liquidity that I just thought about, oh, this is sweet. Liquidity is a nice way to provide other investors who are already invested to exit their positions. I just thought about that. It's like, you know what I'm saying? Somebody said, one thing you have to think about when you're buying a home is whoever's selling it to you, they're using you as their exit, right? You're entering, but they're using you as their exit. You've provided them with liquidity to exit their position in whatever home they bought. Same applies to stocks. So when the stock split occurs, sometimes people are looking at that as, okay, now we're going to get an influx of new investors because they think the price is cheaper when we just divvy it up. And now, because we know we're under hard times and hard times are even closer to coming, we can exit our positions and keep all that cash while they tumble and deal with the downturn that's about to happen. Boom. Voila, magic. So that's, something to think about. And so you're thinking to me, Jermaine, dang, so you're saying that these stock splits happen because there's going to be an economic downturn that's coming soon and the big hedge funds and the big money makers are trying to liquidate their positions? That's just my theory. Another thing to consider is there's something called a yield curve, right? Which basically tracks, on average, we'll say the 2-year bond and the 10-year bond, right? And this tracks, seeing whether or not the 2 years above the 10 or the 10 is above the 2, right? Basically, it's actually now inverted. One went under the other that wasn't supposed to be under the other. And the one that went under the other, which I don't really know because I get mixed up with the 10 and the 2 all the time. I need to do more yield curve research. But basically, what occurred exactly today, right, March 29th, what occurred today is the yield curve inverted, meaning the bond year, right, the 10 or the 2, which usually tracks on top, swapped and is now under and is tracking under something. Once that occurs, right, for the last 50 years, that's usually the sign of a recession. Over the last 50 years, it's proven true. Meaning, if 50 years is telling us what's about to happen, we're about to hit a recession, right? Keep in mind, the last time the yield curve did this action that I'm talking about was August 2019. What happened 6 months later? Economic shutdown, pandemic. Nobody knew the pandemic was going to come, but an economic shutdown was expected. So when the pandemic happened, everybody doing their, BlackRock and Co. doing their analysis, we dumping everything. And then they bought at the bottom. What is 6 months from now? September. What is September traditionally? One of the worst months in the stock market. Coincidence? I think not. So the next 6 months are going to be quite telling. And that's just, it's an estimation, 6 to 18 months until a recession. We'll see where it falls in there. But this is a very, very crucial moment in history. This is a moment where a lot of us who are in this game and who have been stacking our bread and who didn't just ball out on our on our tax refunds and our bonuses, and we kept them. We are going to be at such an advantage when this second downturn happens, because after this, ain't no telling. I think 2024 is going to be a great year for all markets. That's just my opinion. Because of how 2020 ended up being for all markets, right? Crypto, stocks, real estate, you name it. At least towards the end of the year, right? Heading into 2021. So, in my head, 6 to 18 months could be a little scary, because 6 to 18 months after the last yield curve inversion was the pandemic, which sent the market down several percentage points and proved to be an opportunity for a lot of people to get in really, really cheap. I myself saw CrowdStrike go from like $80 to $50 and then go back up to almost $300, if not $300. And that's just a small example of everything that was happening around. We saw Tesla go crazy. We even saw GameStop go crazy. We've seen it. We saw it all happen in front of our eyes, right? And last time the yield curve was inverted, it took 6 months, right, from August to February/March, and then everything went down. So now that the yield curve inversion happened March 29th, by September, October, we may have another downturn. Simply, we just might. Or it could prolong and it could last, maybe it'll happen within the next 18 months, if not 6. Cool. And so this is information that I stumbled upon while doing my research, because I was like, ain't no way everybody's trying to split their stocks now. But now it makes sense, because they're going to be using everybody for liquidity. And they're going to be using you to get out of their positions and run helter-skelter, run different directions. And then when things tank, they're going to be back there to pick up the pieces and buy the dips, because everybody else has paper hands. You buy low, it goes lower, you sell. And they buy it dirt cheap. They use you for liquidity, first of all. Then when it went lower, they bought in again. Because it's crazy. Imagine buying a home, and selling it for cheaper to the person who just bought it from for more money. Let's say I bought a home for $400,000, and I sold it back to the person I bought it for $400,000 for $350,000, and then the price shoots back up to like $450K. That's kind of what happens in the stock market a lot, because people don't wait for these low price targets to hit, or the support levels on these stock prices to hit, and then they sell. And they're also not buying at good prices, because nobody's really thinking about this yield curve inversion, or 6 to 18 months out for a recession, or what is the reason why all these stocks are splitting at the same time? What does that mean for, big, huge hedge funds? And what does that mean for us? And why now? And how does that relate to rising interest rates and inflation? And, but my mind works a crazy way. So with that being said, I feel like I've given crazy game today. So, I'll keep it short, sweet, and simple. And I would like to encourage everybody, that these next months are going to be crazy. So kind of like I said, how there's a predicted recession, probably going into the year 2023. I also predicted that Bitcoin and all crypto would kind of see a slump in 2023, because
I mean, it's been Bitcoin and all the other cryptos have had a lot of momentum since 2020. The next halving event for Bitcoin itself, which makes up most of the crypto market, is going to be in 2024. It can't be hot forever. It has to have a cooling off period. And usually Bitcoin cools off a lot, most frequently by like 80%. It hasn't had an 80% drawdown yet. That's going to be in like the 20Ks, maybe like the sub 20Ks. So I'm just waiting. 2023 is the year of buying for me. I'll be buying a lot. Everything I can get my hands on, I'm buying. You feel me? Because 2024 is going to be the next halving of Bitcoin, which will see Bitcoin reach a new level of scarcity, which should impact the price heavily. By 2023, hopefully, Ethereum 2.0 will be out, and Ethereum will be able to move and change from, proof of whatever to proof of whatever. And then that will also affect it. And then Ethereum might even be able to work on their gas fees as well in the year 2023. So 2024 could be really, really, really dangerous. And I'm a dangerous man. So I will be stacking and stacking and stacking and waiting on my opportunity to get assets at the best points, right? If everything is converging on 2023 as being a bad year for markets, or at least the end of 2022 into 2023, 2024 is going to be something to watch. And I'll be right there with y'all, stacking up this paper and getting to this bag. This has been the Hustle Class Podcast. I appreciate y'all tuning in, and I'll catch y'all next month. Bye.